Good afternoon, everybody. Thank you for being here. So clearly, interesting concept and not a better time for that. So here we start off this thing. There was an interesting piece that I read recently in one of the book by Jim Collins, Good to Great. He mentioned that there are three important attributes to a great management: disciplined people, disciplined thoughts, and disciplined action. I think rather than management, that applies more to portfolio managers. I think that's where a lot of discipline is needed. The way we work into this system, taking so many decisions which balance out risk and return. So in this ever-changing global world, fast-paced, so many changes, so many implications in terms of geopolitical things, black swans, technological changes. Apparently, VUCA becomes a very, very critical piece overall. So in the next 30 minutes, we'll try and discuss how to manage this and how to harness this in the best way that we can do. So without further ado, I think I'll start off with the discussion. I think first question, I will start with Bevo. I think no better time again to discuss geopolitical issues. So in this whole overall scenario of global uncertainties that we see right now, how do you see that rubbing off at India? What are the opportunities you see over there, and where should we be careful around? So that's largely thing.
Yeah. Hi everyone. Thank you for having me on the panel today. So I think geopolitically, India is in a much stronger position than it has been probably in any time in recent history. Also macroeconomically, we're much stronger than we've been maybe at least in the last 10 to 15 years. So my view is that geopolitically, yes, things can rub off on India. I think the two places where it directly affects are probably oil prices and exchange rates. And I think both of those, while it could have a near-term impact, but I think both of those will remain range-bound. So I think beyond that, I think it's not likely to have too much of a meaningful impact. And while I think it could make the markets choppy, but I think India is probably a shining beacon of growth in the global world today, compared to many of the large, economies. So I think that's how I look at it.
Next one, I would pass it on to Anil. I think interesting times when we see markets hitting 20,000, coming off sharply, the sort of volatility we see. Such scenarios, how do you tend to manage, Anil, your client interactions? How do you tend to manage their expectations? So what is typically that you like to do at the time?
One of the important things for us has always been, how do you look at risk-adjusted returns, right? So, and I think part of that is you see a lot of volatility at various points of time. Okay, so what do you do first of all, right? So I think the first thing is, how do you have, let's say, processes? How do you have your systems in place, right, that we are able to achieve a bit of a risk-adjusted return. And I think the proof of the pudding is actually when, say, markets falls, right? So whether it was COVID or, some of the other periods when we see volatility, I think that's a proof of the pudding, right? So I think for investors, a lot of the time, they get a little bit jittered when they see volatility. So I think it's so how do you go about it? How do you communicate? I think also becomes very, very important, right? So right from being able to communicate more actually in such times, right? We are very, very active in terms of trying to, reassure clients that, this is only a snapshot, right? The larger part is there to come. So that's something which, we try to do in terms of communication. And of course, the other part of it is also they actually see it in action, like I said, when they see the returns. And hopefully you're able to hold them through a period when, markets also see the other side of it. Okay, and I think for people who've gone through a bit of a cycle or two, it's not too much of an issue. But I think the communication needs to be much more stronger for those who, just started off and at the initial stage.
I totally agree. I think last 3 years has probably thrown all possible things that probably nature, financial markets, and probably world as a whole can throw on us, right? So we have heavy inflation, high interest rates, geopolitical issues, COVID, probably I'm sure you would have gone through a lot of these things. Moving to you, Anirudh. So 2-3 things that we have seen as a shift of late, the way market participants behave, right? In terms of the participation by FIIs, in terms of the participation by DIIs. In fact, the number of accounts which are being opened by individual investors have increased rapidly. So in this scenario, when you look at multiple players, FIIs, DIIs, individual investors, how do you look at that data, Anirudh? How do you look at that data? You look at it on a collective piece, or do you look at it as a individual piece? How do you look at that data?
Okay, see, I believe that the behavior of individual investors is more or less the same. In the last 15 years, if we look at, there's been a huge effort done by SEBI and mutual funds to educate investors. I think, for me, the best product for a retail investor is a mutual fund. You're guided by the best managers out there, and you can chip in the least possible amounts. When it comes to the behavior of FIIs and DIIs, I believe that, the world, how we see it, is divided into two, we call it the two-run theory, where one is an old economy run and the other is a new economy run. We were just talking about when the ICICI Pru presentation was going on. So one is more of a capex-oriented run and one is more of a consumption-oriented run. You can call it more of a value run and more of a quality run as we see it. So you in a capex run, you get more of, I would say, more capex, high growth, high GDP, and a lot of credit is there, high inflation is there, and it's vice versa in a quality run. FIIs, we believe they focus more on quality because that is how they have been thinking throughout. They invest more in quality stocks, more in consumption-led, more in IT. And DIIs, we believe, to a bit, are more inclined towards capex as well. I would say more than FIIs. So if we see the behavior of FIIs and DIIs in the past 2 years especially, see how it has shifted. If we see from 2010, I would say from 2010 to 2020, pre-COVID or a little bit post-COVID also, it was FIIs that were making majority of the money. But they have been net sellers after that. And if we are talking about DIIs post that, they have been, whatever the FIIs are selling, DIIs have been buying into that, especially supported by the money that has been put in by the retail in India. So yeah, it keeps on oscillating between FIIs and DIIs, but I believe in terms of an average investor, mutual funds is the best product. The only thing that I've noted that an average investor is stuck up in is this, what has happened in the last 10 years, they are more stuck in the recency bias, I would say. Yeah. So I believe back in 2009-10, stocks like Asian Paints, nobody was buying them. TCS, nobody was buying them, and now everybody wants to chip into an Asian Paints. So the recency bias, I believe, plays an important role in retail investors' point, and that is something that one should take care. And it is best to go through structured products and mutual funds and stuff like that for retail, I believe. Yeah.
Interesting. Thanks. So after macro piece, I think let's zoom in a bit further deep. Let's dig a bit more around that. So again, I'll catch all of you. I think would love to know what sort of stock selection process do you follow? Especially, I think Motilal generally was never into the new age companies, and now probably you started looking at that part. So when you look at that piece, how do you look at companies and especially management? So how do you look at that piece?
So I think at Motilal Oswal, we are proponents of the high quality, high growth style of investing. And our recent focus has been upping the quotient of growth. So I think a lot of the new age companies, when they came, both the valuations were frothy, and even the managements, I think at that point were focused on the earlier style, which was kind of burn capital, acquire users. But I think once the markets kind of, they saw a period of consolidation. And I think then the focus moved towards profitability and profitable growth. So I think, and these are managements, I'm not saying all of them are, but some of the good ones, when these guys move in one direction or when they put their eyes on one metric, they move at a pace much faster than most of the other managements can. So I think that's where we took exposure to 2 or 3 names in that space. I think coming to our broad stock selection process, we look at again high quality management, sector leaders, companies which have good earnings potential, and I think valuations are extremely important for us. And I think one thing we've also started doing incrementally is focusing on risk management, where we have a defined sector limit, stock positioning limit. We have clear sort of exit mechanisms. So I think broadly this is how our stock selection process goes.
So I think if one way to look at these stocks would be from a fundamental perspective, I think the other side would be from the quant perspective. So when I say quant, I think Anirudh, I can bring you into the discussion. So when you look at stocks from a quant perspective, Anirudh, how do you look at these names and what are the things that you look out for?
Okay, so I'll try to answer this in a little more detail. So quant is a very misinterpreted word. I believe quant is nothing but your human ideas, your experience that you've gained for us the past 30 years that we have been into the market, just translated into a code so that when you're on the pitch, where every day is different, every ball is different, you have a set of rules, a set of ideas through which you have to work with, so you do not find yourself in a non-playable zone. Yeah, so when we see how we at INVasset have decoded quant is that we have developed something called a valuation metric index, where we try in layman's language to classify the markets into 4 broad scenarios, not exactly timing the markets, but a broad qualification that whether the markets are underpriced or oversold, or they are, I would say, in a new fresh bull run, or they are expensive, or they are exuberant, these 4 stages. So when we find that the markets are oversold, as it happened in March 2020 or June 2021, that time we go in for value investing. We believe that our hypothesis is that one should look for value only when there is value in the overall market. What may seem value in a bull run can sometimes be a value trap because all the information not coming out. And then when we see that we are in a fresh bull run, then we go in for those stocks. The hypothesis here is that firstly, markets reward relative growth. In a new bull run, markets reward relative growth. And secondly, every bull run has a new leader, either in terms of, which is well said, sector, stock, group, due to some change that has happened in the market. And that can be on a national level, sector level, company level, or even a geopolitical level. You just have to assess what that change is and how big it is and what is its impact on the top line and the bottom line. And finally, every couple of years, you feel that when the markets are expensive, a lot of parameters go into deciding what phase it is. And when the markets are expensive, we go in for quality investing. All those good Warren Buffett type comfortable companies where, there is very good management and the financials are perfect, where it's high ROCE, high ROE, free cash flows are available and good moats are there. And all those companies which can sustain on their own. Even if we go into a bear run from here, okay, they will not fall more than 20%. And finally, every 5-6 years, we've been into the market long enough to see that you get those bouts of exuberance where everybody wants to leave their jobs and come into the stock market, and then there comes a fancy IPO that everybody wants to pitch in. So those are the times we believe that our hypothesis there is that, okay, we are all investors here and not particularly stock market investors. Sometimes your favorite companies also may go into the market itself goes into a stage where it is not sustainable. So that time we believe that we'll either go into ultra low beta stocks or maybe stay out of the market for a while and take a breather. So this is what automatically our quant system revolves in these 4 stages.
I think so broadly that's how you're able to manage your overall volatility as well in the system. So clearly Weber comes from a top-down school, you're into quant. So I'll go to Anil sir. I guess you are more around a bottom-up approach. So I would love to know how you take this whole piece forward, how you look at the bottom-up approach, and incrementally, how do you manage risk in that case? How do you manage the consistency of returns in that situation?
Yeah, so like I said, I think I'll start with the second question in terms of consistency because it is an extension of the previous one, right? So, and that's very, very important for us as a fund house, right? So somewhere it's a lot of it is about process. It comes from my own experiences, being on the technology side and with Wipro and stuff. So the whole investing journey is sort of, each of them is a process for us, right? So that is one. The second is we take decisions which are a lot of, based on data oriented. Just an example is prior to COVID, we actually went and de-risked, okay? Because I think if you looked at the P ratio at that point of time, it had hit, almost like 28, 29, right? So Nifty. So those are points where, we look at data rather than things. So it helps us manage risk better. Right. So the other part of it, coming back to from a stock picking, we have maybe a couple of portfolios at least which are say mid and small cap, where I think bottoms up definitely is something which is sort of important. We may have a flexi cap, which you will need to do a combination of it. Right. So what's a key way of if I look at the thought process is to look at growth at reasonable valuation. Right. So and that becomes also, it makes it less risky for clients if the valuation is not too heavy, right? And both of it is important. Bottoms up, maybe first is, let's say, the process, but then you need to go deep dive into the individual companies, see what is it, the headwinds, the tailwinds, what are their moats, etc. And then you get value. So, and it's been good for us because we've tried to make that also as a process. In fact, a multi-bagger process that we call, and we have almost like, I think 20 stocks over the last 3 years which have been multi-baggers, right? So that shows that, if you're able to look at, also the companies which are at an inflection point also in terms of valuation, where they get discovered, they also, end up giving a much, much larger, value because there's an expansion of also the PE apart from just the earnings growth and the impact on valuations on that.
So of late, we have seen this whole clan of ESG companies coming up sharp, doing pretty well, that being a pretty important part of the system of late. I guess, you look at ethical companies as well, right? So when you do that whole ethical investing piece, so how does that process work?
So I think we have an ethical PMS. So the idea of the ethical PMS is that there are 2 or 3 tenets to it. One is that there are certain community guidelines around not investing in companies that have exposure to alcohol, tobacco, gambling, maybe in some cases even financial services companies. And second is that some of these companies also should sort of be more environmentally friendly, which has parallels to ESG investing. So I think, ethical sort of plays both on the ESG front and, on certain sort of community guidelines on, sort of what constitutes an ethical company. And that's how we look at it.
Anirudh would like to make you slightly uncomfortable now. Apparently, on the quantitative side, it's believed that churn rates are slightly high, right? So when you talk about higher churn rates, when you talk about exit strategies, how do you manage that?
Okay, so Quant's having high churn rate. I think it's based on model to model. If we talk about what we do at INVasset, I told you we have 4 stages. So the last churn that we did in our portfolio was in November 2022. So any clients who have been with us for more than a year, this month and they'll all be in long-term capital gains. So it depends upon the model to model. We believe that once we recognize a stage and we have our research ready on what companies to pitch in, there's not a lot of churning. So for us, churning rate is, I would say our portfolio is churned maybe once a year to be like the 4 stages, they take around 4 years to complete, traditionally, based on historical data. In terms of exit, when you're talking about, so we exit the markets, we exit the bull phase in 2 ways. One's when we feel that the markets are expensive, though our criteria of expensive markets is very, very lenient. We believe that preservation of capital is much, much more important than the generation of alpha. So whenever we feel that, whenever the matrix suggests that now, okay, the markets are expensive. As I told you, we go in for those high quality shares, those Warren Buffett shares. And yeah, once every 5-6 years, those exuberancy also comes, and then we take a decision to exit the markets. Stock-wise exits we do not take until and unless something goes absolutely wrong, which totally negates our theory. Sometimes what happens is that when you sell a stock which has been growing too much, or you clip it in its bull run, I think the losses there are much more than the losses that you can hold while you can make while holding a bad stock. If you sold your INVasset in 1999 or something, I think it would have taken years to come out of that shock. Or maybe if you sold your L&Ts and Reliances in the 2007s, or if you sold your Bajaj Finances in the last run. So yeah, hold on to your winners, cut your losers, but keep the churning very, very low is what we believe.
So churn is clearly not questionable, this thing, that's what you believe. Anil sir, an important question around asset allocation. So in this whole scenario that we are looking at right now, building around, on one side we are seeing some tensions around geopolitical scenarios, state elections coming in, central elections coming in, and then the whole idea about India growing. So if one was supposed to look at allocations from a 3 to 5 year horizon, how would you place that?
Sure. Actually, it's very difficult to do an asset allocation advice for somebody generically. Right? Okay. So I don't think you can have a generic number for everybody, because a lot of it is on their own risk profile, right? So I think, just stepping back, I am a great proponent of having a good asset allocation, okay? And it's very important for investors. I think just a simple thumb rule can be 100 minus your age, just to, ideally you should do a financial plan and then look at your asset allocation, right? So that is something which is there. Now, coming from there, right, I would believe, like, today a lot of people are saying there's volatility, there's so much of noise and various things are happening. And I'm wondering, what were they saying, when it was, say, the PE was 28, 29. Right now we are closer to 20, right? So, so sometimes I'm a little surprised at, some of it, which is why I like to look at numbers and data. And even while looking at an asset allocation, I would rather look at a dynamic asset allocation, right? So when, and just the most simplistic form can be, okay, if my P ratio is low, I'll be higher in equity than, say, my average allocation. And let's say if it's very high, then I can actually lower it there. Okay, that can be a very simplistic one. Of course, I think you need to look at data and various other points, and you may have to do it at various points of time rather than just a simple formula like that. Right? So I think for investors, it's about, I think, how they can also not be carried away by the noise. Asset allocation is definitely one way to also do that. But if you can also get a little more intelligent on saying that, okay, when markets are really high, and by high I'm not saying that you're all-time peak, because I think the whole point of all-time peak is a fallacy, because, right, it's relative valuation rather than absolute. Okay, and the media may, it may just come back that, okay, we are at all-time high, so, there's a lot of noise there. So I think, how do you get back and not get carried away, follow it, and possibly I'm saying that, a dynamic allocation may be better in terms of between, let's say, mid caps, large caps, etc., which is, I guess, one of the points that everybody is asking. Again, they say, oh, small caps have gone up, some 35-40%, okay, and it's really good, so should I get money out of it? Again, we track data, we track relative valuations, and interestingly, we gave a buy call on mid and small cap, but it was a contrarian call, end of March 23, okay, when there was a lot of negative news and FIs were pulling out money, you had the 𝑠vb crisis, all of it. So that is something that and what the data that we've seen is, typically it lasts 2 years. Again, typical cycle is, say, 3.2x. Okay, they're not necessarily small numbers. So many times, we see something, yes, it's done very well, and jump out of it only to see that, there is volatility out there. And that's something that we should be clear. Volatility is there, right? But how do you look at data and then maybe take your decisions?
I think we have got a while. Just a few minutes left. I think I'll squeeze in one more question. I'll bring you in. So festive season's about to start. Result season's about to end. So I think things are out there in the open. Which are the themes that you would be looking forward post the result season and the festive season one?
Yeah, so I think we look at themes that are sort of more longer term in nature. So if we take a slightly longer term view, I think where the earnings growth is likely to remain for a period of time. I think certain NBFCs and certain mid-sized banks give that opportunity. Certain names on the discretionary consumption side give that opportunity. We also see certain names in the hospital space that seem to have good longevity of growth. So I think if you take a secular view, that's how I would look at it. But if you're looking for a nearer term view, then obviously your typical like your automobiles and certain discretionary names, companies in the jewelry space. These are the names that typically tend to do well at this time of the year. So I think that's how maybe you can look at the sectors or the names based on your time horizon.
So still more around consumption sort of themes is what you would probably look at.
So as I mentioned, I think there are...
I think that's largely what you're looking at. Okay, but interesting. So I think broadly, ladies and gentlemen, that's what we were discussing around. Thank you, Anil. Thank you, Anirudh. Thank you, 𝑨𝒏𝒊𝒂𝒂, for your time.